Hi, I'm Debra, and today I'm going to be talking about the 7701 B10 trap, when U.S. residency doesn't end at departure. Just as a little preview, what I'm going to be talking about today is a specific example of someone who leaves the U.S. and sells some U.S. stocks, and they want it to be free of capital gains tax in the U.S. So the question we're asking is, can you end your U.S. residence, sell your U.S. stocks free of capital gains tax, and become a resident again? Section 7701B10 says maybe not. If you return too soon, the IRS can treat income during the gap non-residency period as taxable under Section 877B and D, which makes U.S. stock gains taxable. So who does this potentially apply to? Anyone who qualifies as a U.S. resident under the substantial presence test for 3 or more consecutive calendar years, then leaves, or it applies to green card holders who have been U.S. residents for 3 or more consecutive years, but have had their green cards during less than 8 of the last 15 years. In other words, they haven't had the green cards long enough to become what's called a long-term resident under the expatriation rules. So they have the green card, and they decide to terminate the green card or make the treaty election to be taxed as a non-resident before they become a long-term resident and would be subject to the expatriation rules. So either one of those two situations, substantial presence test or green card, but you've had it during less than 8 years. So, just a little bit of background on residency rules. 7701B1 says you're a resident if you have the green card or you meet the substantial presence test. The substantial presence test is a 183-day rule applied via a weighted 3-year formula. So you look at the number of days in the current year, then you take the prior year days in the US and you multiply it by 1/3, plus you add the days from the 2 years ago, multiplied by 1/6, and you add all of that up, and if it's 183 days or more, then you're a resident under the substantial presence test. And just one thing to note is that this test is only applied if you were in the U.S. for 31 days or more in the current year. And when we say current year, we mean the year you're looking at to apply the test. Now, when we're talking about residency termination, or how treaties may interact with your U.S. resident status, you can override your resident status using the dual residency rules, the tiebreaker rules in the treaty, if you qualify, and you would disclose that on Form 8833. You can use the closer connection exception if you don't have a green card. You disclose that on Form 8840. And for residency termination, this defaults to December 31st if you terminate your residency during the year, but 7701B2 allows an earlier termination date if you have a tax home in and a closer connection to a foreign country. And for the closer connection, it's the same exact thing I was mentioning above with the closer connection. Look at the Form 8840 for the closer connection criteria. Now, what the resumption rule under 7701B10 says is that if you're a tax resident of the U.S. for 3 consecutive calendar years, then you stop being treated as a resident, and then you become a resident again before the close of the 3rd calendar year, beginning after the close of the initial residency period, then you're taxed under 877B for the non-resident period. So we bring in the old expatriation rules under 877, but just the part of it where it talks about how certain things will be taxed. So you have this little loophole closure where certain items of income get taxed as if you're a resident. And just to put this in very plain English, the resumption rule says that you must remain a non-resident for 3 full calendar years before returning, or the IRS taxes some of your income as if you didn't leave. And intent doesn't matter here. If you become a resident by accident, the rule still applies. And it's important to note that 7701B10 applies no matter how you end residency. You can stop meeting the substantial presence test. You can terminate your green card by filing Form I-407. You can use the earlier termination date under 7701B2B and also see Publication 519. You can use a treaty position under the tiebreaker rules. You can claim a closer connection on Form 8840, which, as I mentioned before, is not available to green card holders, but it's available to everyone else other than citizens. So let's say you're in this situation where you terminate residency and then you come back too soon. What happens? Well, you're taxed under Section 877B. This just provides the framework imported by 7701B10. So it refers you to Section 877D, which creates special U.S. source rules for income during that period. And in particular, the one that we're concerned with today is Section 877D1 Cap B. Gains from stock of a domestic corporation are treated as U.S. source. What these sections don't do, they don't make you an expatriate, they don't cause you to have to pay exit tax, and they don't require you to file Form 8854. It just brings in certain types of income during that intervening non-residency period after you leave and before you come back, and it says we're going to tax these items as if you didn't stop being a resident. So let's look at an example. Let's say a taxpayer is a resident alien under the substantial presence test for 2022, 2023, and 2024. That's 3 full calendar years. They leave the U.S. on September 30, 2025. They don't return that year, and they qualify for the earlier termination date of September 30th, 2025. On November 1st, 2025, this person sells the stock of a U.S. company and generates $20 million of gain. They then remain abroad all of 2026, 2027, 2028 as a non-resident alien, and then on January 15th, 2029, they return to the U.S. and a new residency period begins. In this situation, this person is going to be safe. The $20 million of gains will be tax-free. And this is because they remained outside of the U.S. for 3 full calendar years before becoming a resident again. That means that when they do become a resident again in 2029, the stock sale that took place on November 1st, 2025 is not suddenly retroactively brought back into U.S. source income. So they win. Now let's say we have the same exact fact pattern as before, except the taxpayer returns to the U.S. on December 30th, 2028 and begins residency again as of December 30th, 2028. In that case, even though they sold the stock on November 1st, 2025, and 3 years, 365-day periods have passed since they sold the stock, doesn't matter because they don't have 3 full calendar years of non-residency between their 2 residency periods. So the $20 million of capital gains from 2025 becomes retroactively taxable under Section 877B and D. So we can see how in this specific, somewhat exaggerated example, a 16-day difference in the return date makes a 7-figure difference in tax liability. Practical guidance. So don't confuse the application of Section 877B in very limited circumstances with 877 Cap A. This is not an exit tax. This is something that just forces you to bridge a gap if you don't remain a non-resident for long enough. So if you want to have a safe return to the US, leave and remain a non-resident for 3 full calendar years, then return in the 4th year or later. And the really important thing here is calendar years. Don't think about it as 3 full years like I left on September 30 so I can come back on October 1 the following year. You need to be out for 3 full calendar years. If a client can't stay out that long, then you're going to want to calculate tax exposure for the non-residency period using 877B and D so that they can get an accurate picture of what their U.S. tax liability is going to be. If you're using a treaty election, make sure to file your 8833. If you're filing a Form 8840 and using the closer connection, document that carefully, and if you're using it for an earlier termination date, document all your criteria. Maybe consider not taking aggressive positions on residency issues, especially when you're looking at like the little de minimis exceptions, things like that. I wouldn't necessarily call those aggressive positions. They're written right into the code and the regs, but if you have $20 million of gain at stake, maybe you want to play it exceptionally safe. And then lastly, don't accidentally expatriate. If you had your green card during 8 or more of the last 15 years, then you're actually what's called a long-term resident. And if you terminate the green card at that point, you'll be an expatriate and you could potentially be subject to exit tax. Just a quick summary to wrap up. So 7701B10 says that if you return too soon after ending your U.S. residency and you resume your U.S. residency before 3 full calendar years has passed, then the gap period is taxed under Section 877B, which points you to 877D, and 877D1 Cap B says that domestic stock gains are going to be considered U.S. sourced during that gap period, and you only have a safe return for U.S. tax purposes after 3 full calendar years of non-residency. So in the slightly exaggerated example that I gave here today, a $20 million stock gain can either be tax-free or fully taxed in the U.S. depending on your timing. Thanks for listening. My contact information is here. If you have any questions, please feel free to reach out, and I'll see you next month.